Are you investing based on a strategy that actually fits your life? Or are you just copying what you see online? Because here's the truth. The perfect portfolio in your 20s could completely destroy your financial security in your 60s. In this video, I'll break down the smartest portfolio split for every age group, so you can stop guessing and start investing with a plan. Welcome back to The Borderless Investor, where we simplify global investing so anyone can build long-term wealth. Today, you'll learn the ideal portfolio allocation by age, why those allocations actually work, and how to apply this with just one tool. ETFs. Let me remind you again, in case you are wondering what an ETF is. An exchange-traded fund is essentially a basket of different investments, like stocks or bonds, that you can buy and sell as a single package on the stock market. Why age matters. Your age determines two critical things: your time horizon and your risk tolerance. When you're younger, market crashes are temporary setbacks. When you're older, they can permanently damage your portfolio. This is why your strategy should evolve over time, from aggressive growth to stability to income and protection. Framework. Every simple, effective portfolio has three core parts: equities for growth, bonds for stability, optional tilts like emerging markets or real estate for diversification or income. And here are the rules. Keep it simple. 1 or 2 ETF is enough. Invest consistently. Rebalance once a year. And gradually reduce risk as you age. Age splits. 20s aggressive growth, 40-plus year horizon. 90 to 95% equity stocks, 5 to 10% bonds. At this stage, your biggest advantage is time. Short-term volatility doesn't matter. What matters is staying invested and maximizing growth. A simple global ETF like VT or VWRA or VOO can already do most of the work. 30s, growth-focused 30-plus year horizon, 85 to 90% equity stocks, 10 to 15% bonds. You're still heavily focused on growth. But now you start adding a small buffer. Life gets more complex. Careers, families, responsibilities. This is where stability begins to matter slightly more. 40s balanced growth, 20-plus year horizon. 75 to 80% equity stocks, 20 to 25% bonds. You're still growing your portfolio. But large losses now take longer to recover from. Some investors also add small exposure to emerging markets or REITs here to improve diversification. 50s, conservative growth, 10, 20-year horizon. 65 to 70% equity stocks, 30 to 35% bonds. At this stage, protecting your downside becomes more important because a major market crash right before retirement can significantly delay your financial goals. If you're getting value from this, consider subscribing. Most people watch but don't subscribe, and you don't want to miss what's coming next. 60s, income and preservation 5, 15-year, 50 to 60% equity stocks, 40 to 50% bonds. Now your focus shifts toward income and stability. This is also where something called sequence of returns risk becomes important, which means early losses during retirement can have a lasting impact. So smoother returns matter more than maximum growth. 70 plus, capital preservation 0, 10-year horizon, 30 to 50% equity stocks, 50 to 70% bonds, plus a cash buffer. At this stage, the priority is simple: protect your capital, maintain income, and avoid major drawdowns. A cash reserve also helps avoid selling investments during market downturns. Important note, these are guidelines, not fixed rules. You can adjust based on your personal risk tolerance, income stability, and retirement timeline. Some investors stay aggressive longer. Others prefer more safety earlier. How to implement. Here's how to actually build this in a simple way. Step 1. Choose one global ETF, like VT or VWRA. Step 2. Add a bond ETF. Step 3. Invest consistently every month. Step 4. Rebalance once per year. And finally, keep 3 to 6 months of expenses in cash outside your portfolio as an emergency buffer for unexpected expenses. That's it. No complexity needed. Common mistakes. Here's what to avoid. copying aggressive strategies that don't match your situation, overcomplicating your portfolio with too many ETFs, and panic selling during market downturns. Consistency beats everything. Your portfolio should match your age, but more importantly, it should match your behavior. Because the best portfolio isn't the most aggressive one, it's the one you can stick with. If this helped you, subscribe to the channel. It genuinely helps us grow and bring you more content like this. And next, we'll break down how the current US-Iran war is impacting your investments, so make sure you don't miss it.